Right. Good morning, good afternoon, and good evening to wherever you may be joining us from around the globe. Welcome to this, my webinar that I'm doing on financial literacy, which I have named or titled Savings and Investments for Dummies, something I realize afterwards perhaps shows my age from those books, Coding for Dummies and Investing for Dummies. Probably not appropriate for the current day and age. So let's get started.
At Holborn Assets, we know that trust is the foundation of any financial partnership. For over 25 years, we have been more than a financial services company. We have been a trusted partner to over 20,000 clients with 26 offices across 18 countries. Our dedication to our clients has earned us a 5-star rating on Trustpilot with over 2,000 glowing reviews. As a fully regulated, multi-award winning company, we are trusted with managing over $2 billion in assets. Our team of fully qualified advisors is committed to providing you with personalized, market-leading financial solutions. Choose Holborn Assets, your trusted partner in wealth management and financial advice. Visit our website or call us today to start your journey towards financial success.
Right, thank you and welcome everyone. Just a very quick disclaimer. The fact that while we ensure everything is accurate, please note that when it comes to financial advice and anything with regards to finances, everyone's circumstances are different, and therefore you need to reach out to a wealth manager or financial advisor for advice tailored to your specific solution based not only on what your goals and needs are, but also where you are within the world. There are different regulations that conform to different countries. A little bit of information about Holborn. So that video is a little bit outdated. We were founded over a quarter century ago. We're currently the second largest independently owned independent financial advisory globally. We have just over $3 billion in terms of assets under advisement, and we are in 18 countries across the globe, managing the wealth of over 30,000 different clients. Some information about myself, just so that you know who is giving you the information and who is leading this webinar today. I am Matthew Theron. I am a senior associate with Holborn Assets, and I focus on financial solutions in the international market. I'm a cross-border financial planning specialist, as I have a vast information, experience, and qualification in terms of investment as well as taxation, and I've lived and worked around the globe. Very familiar with different jurisdictions and different challenges, experienced by expats from around the globe, and that seems to become a natural part of the advice that I give lately. In terms of qualifications, I am internationally qualified through the Chartered Institute for Securities and Investments in the UK, where I've passed both my level 3 and level 4 chartered exams in international wealth management and advanced wealth management. I have an NQF 6 level qualification or postgraduate qualification in corporate tax, as well as personal income tax, and then an NQF 7 program in advanced tax law with UNISA. I have a national diploma in financial management, and I have a tertiary level qualification or advanced qualification in financial investments, as well as alternative investments and estate planning in South Africa. And I passed my regulatory exam, allowing me to give advice within South Africa, the RE5. Now, when it comes to reviews about me, you'll see there are a number of reviews. You can go on to Trustpilot, go to Holborn Assets, and then filter it down to Matthew Theron, and you'll see there are a number. If you want to know a bit about me, here, the fact that I'm well-organized, knowledgeable, and professional. How do I get this video to play? Let's do that. Click. Okay, it's not working. I was going to have a whole row of reviews, but you'll see that just go to Trustpilot, search for Matthew, and you'll see countless reviews about my professionalism, the knowledge, the experience, and the benefit that many clients from around the globe get from my experience. Now, something that gets asked very often when you live abroad as an expat, people often ask me, where do I set up my investments, my savings? Do I set something up back home or keep it abroad? Are there other options available to me? My advisor back home gave me an endowment and an RA. I hear that way too many times, unfortunately. I have a tax-free savings back home and a retirement plan. I don't know what to do. Do I just leave it in my bank account? And this is what scares me when I speak to clients abroad and they tell me, with regards to their existing investments and savings, well, I don't know what it is. My dad's advisor set it up for me. You should always know what it is you have, where it is, and what you're actually investing in. But that's a story for a different time. So what is the aim then of today? So the aim of today is to simplify savings and investments, to make it easier, dumbing it down for the majority of people out there who want to understand and want to know, what do I do with my hard-earned money? And to make it simpler, I thought I would look at wealth as a journey. How do we get to where we want to be? Same as if you're going on holiday, how do you get to your destination? We'll go through some of the jargon or lingo that you will often come across, some of the options that are available to you, and how to narrow down those options when it comes to looking at things such as tax and currency, whether or not you need to get advice or whether you are able to do it yourself or go it alone. We will look at the many different risks that are involved, and we will cut through those many options, those opinions, the tide versus independent advice. How do we go about looking through all of that? And then ending up with my 7 simple steps to building personal wealth, my sort of personal guide based on what I've used. So let's start then, and let's look at wealth as a journey. Now, if we're going to go on a journey, we need certain things that you need to know. There's certain things that we need to be able to understand before we just embark on this epic adventure. Well, where do you want to go? How long do you have to get there? How much will it cost? Very simple. You need to know what it's going to cost. What type of transport will get me there in time? And are there going to be any distractions or attractions along the way that I need to be able to account for? Now, if we look at wealth in that exact same perspective, or from that exact same perspective, what are you saving for? The amount of times I meet with people, and the biggest job for me when it comes to giving advice and helping to build portfolios and build client wealth is, what are you doing it for? If you know what you want, it's easy to find a way to get you there. But if I don't know what I want, I don't know when I want it, then it makes life a lot more complicated. So as a journey, where do you want to go? What are you saving for? When do you want to be able to reach that goal? How much do you need to be able to save or put away or grow to be able to reach that goal in time? What type of investment will get you there in time? Are you going to be going via boat, via plane, via train, via bus? Same. Are you going to be investing in something that is like property? Is it going to be something that is stocks and equities in nature? Is it going to be fixed income? Or what will get you there? And then, will you need to access your investments and your savings for other unforeseen needs or for other things along the way? Because that will, those distractions or those attractions you want to be able to do along that journey, we need to be able to account for those as well. So let's go into that. Now, what is route planning? When you're going on a journey, route planning is the process of determining the most efficient way to reach that destination. It involves analyzing various factors such as the traffic, the road conditions, delivery schedules, and it helps you to be able to create an optimized route. So route planning aims to minimize costs and maximize efficiency by finding the best sequence of stops along the route to get you where you want to be. And very simply, a good wealth manager or financial planner will be able to take this into cognizance when creating and finding a solution for you. And that's where it becomes very key and very important. Being able to find a solution that suits where you want to be, when you want to be there, and the most efficient way to get you there. So there we have your strategic route planning. Now you do your homework. You want to know what you want, how long you have, how much will you need, what options will get you there, what are the costs, account for detours, and find a solution to keep you on track. Then create a plan, the things that you need to do, the things that you must do after you've looked at your actual reality. Create a plan using that info. Make sure that it matches your goals. Make sure it matches your timeline. An investment or savings plan, no matter how great, is completely useless if it doesn't match what you want to be able to do in the timeline that you want to be able to do it. Make sure that it matches your budget. It's perfectly fine saying, I want to go from Nairobi to Las Vegas, and I'm going to take a car. It's not going to match my timeline. It'll take me forever to get there. At the same time, I'm not going to, if I can't afford to fly on a jet, private charter jet, it doesn't match my budget. So, you need to make sure that all of these things are taken into account. So make sure it also matches your accessibility needs. I'm going to need certain funds along the way. And then make sure that it matches your mode of transport. Then we can improve that. Make adjustments. Once you've started, you make improvements to your actual portfolios and do your investments along the way. Do regular reviews and checks to make sure that you are on track. There's one expression that I found quite helpful over the last few years, and that is that any investment without tracking is simply just dumping money. You need to be able to track what you're doing and if it's getting you to where you want to be able to do. So make changes if needed to get you back on track where you have gone off from that route. If you've had to, for some other reason, make a pit stop because you've run out of petrol, don't just carry on along a new route. Try and find your way back to where you wanted to be. And then if the goalpost has moved, make changes that align your vehicle to that new timeline. Continue to improve. Fine-tune things as you go. Make sure it keeps you on track. And then finally, something to help you get to your vision. And I see that's now moved over. I haven't fixed that on the PowerPoint slide. But make sure you know at all times where you are heading. Make sure you know where it is you want to be and help yourself get to that point. So that is wealth as a journey. And the reason why I like wealth as a journey when it comes to explaining wealth, savings, and investments to clients is because it's an easy thing. You want to know where you want to go, how you're going to get there, what mode of transport you want to be able to use. And all of that comes with figuring out the solution that best suits a client rather than off the shelf. I don't care if you're going to Las Vegas or whether you're going to Nairobi or whether you're going to Seoul or whether you're going to London, we're just going to put you all on the same bus. Clearly, that does not work. So now that we've looked at wealth as a journey, we have an idea from a basic principle. When it comes to saving investments, start off simple. Think of it as a journey and then plot your destination, look at your costs, look at where you want to go, how you're going to get there, and then you look at what types of investments will actually get you to where you want to be able to be. So one thing that you'll come across a lot in this industry, or when it comes to financial services, is terminology and lingo. So to be able to help you navigate some of that, let's explain some of that. Now, there is a lot in the world. I mean, something as simple as savings and investments. What is the difference? Well, they are very different. They're not the same thing. Saving is putting money away and looking after money in its most simplest form. Investing is growing that money. Think of saving as the foundation of a home. Investing is then building that home, building upon that foundation. We will look at things such as local versus offshore. What is offshore? And then we'll look at what is really offshore. because there's a lot that's offshore that's actually local, just structured in a way so that it looks like it gets access to offshore. What is active versus passive? That's something you'll come across quite a lot. We will look at investing versus day trading. What are the differences there? Asset swaps, risk profiles and risk appetites. We'll look at mutual funds, term AMCs versus OCF, EAC versus RIY, your effective annual cost versus your reduction in yields. What is domicile? What is your net return versus a real return? Annualized return, cumulative performance, interest rates, coupons. There is so much lingo out there, and being able to understand that lingo is very important when it comes to choosing what is the right solution for you and your journey. So let's start with something as simple as I said earlier, as just savings versus investments. And I've made a little table here to compare them. Now, if we look at savings, savings represents that part of your income that you don't spend, something that you want to be able to keep. You want to be able to protect that money. It's a safety net. It's made to fulfill that short-term urgent requirements. It's not something that you're going to put into some type of investment that's going to go up and down or is going to be fixed into property. It's looking after your money for the shorter term needs. It's usually those emergency funds, to put a deposit down on a car or on a home, something that you're going to use within the next 2 to 3 years. In terms of risks, when it comes to savings, there's a lot less risk when it comes to savings. It's low or negligible. And something you will notice that I don't say that there is no risk. I say there is low or negligible risks. Any savings or investments comes with some form of risk. And we will look at that later on. What are the returns? What can you expect to get? What kind of growth can you expect to get? And this is where people often, refer to interest when it comes to bank, coupons when it comes to bonds, returns when it comes to investment portfolios. So what kind of growth can you expect? Very often you can expect no growth, or even less, very little growth. But it is highly liquid. You can go tomorrow and go and spend that money. You don't have to worry about markets being down. You don't have to worry about giving a notice period, or having to sell out of something and waiting that willing seller, willing buyer. It's a lot more easy. Investments, on the other hand, if we look at what is an actual investment, that refers to the process of actually investing in capital assets with a view to actually make money. So again, it's not that foundation, that safety net, it's that building that actual home, building that wealth, trying to make that money worth more, to grow it in excess of inflation. And again, if we look at that purpose, it's simply that, to grow or build wealth, to make it worth more, to provide returns and to help in actually building that capital. So what are the risks? Well, this is where the risks start to become a little more than they are in terms of savings. And you have that medium to very high sort of risks, where I like to refer to it as that seesaw, that high growth and high risk versus your lower growth and lower risks. And if we look at what can you expect to return, how do you expect your money, it can be comparatively high compared to savings. The problem, though, is that it is often less liquid, in that depending on the type of investment you go for, let's say you went with property, it could take you a few months to a year or a few years to be able to sell that property and get the price you want, without losing money or without making a loss, waiting for that right moment. If you're into different types of markets, you may find that it's just the wrong time. Someone has said something dumb or bombed someone and the markets have dropped out, and now you need to wait a few months for those markets to recover. So it's not as simple as going to the bank. Yeah, I'm not earning much money on it, but I can go there tomorrow, take out my money and spend it. So that is why it's less liquid. So very simply put, saving is protecting what you have for that shorter term. Investment is growing what you have for that more medium to longer term. Now, we mentioned interest earlier, or returns, and then also what is real returns. So when you're looking at different scenarios and different options, how are these different? Well, very simply, if we look at interest, Interest is that percentage that the bank will give you for money that you've put with them, or it's also the percentage that they will charge you for monies that you've loaned from them. And what affects interest that you earn at a bank? Well, it'll be the exchange rates, it'll be the inflation, it'll be the economy. All of that will affect interest rates within a country, and that will then affect the interest rates that the banks give you. They don't move very quickly, or historically, they don't move very quickly unless something unforeseen happens, like something as COVID, and governments have to intervene and go and change interest rates to be able to, affect markets. But generally, they move very slowly. If we look at a return, well, that is the percentage that an investment has grown by, not that a bank will give you in terms of growth. What affects a return versus an interest rate? Well, here it's often the value of the underlying asset. The value of the underlying stocks and shares, and the value of the underlying art or vehicles or properties or whatever it is that you have within that investment portfolio. And what are the primary things that will affect that? Well, supply and demand. Interest rates will affect it, market conditions, more so than anything else. It'll be that fear and greed. Investors tend to get fearful and sell, or they get greedy and they start to buy. And then also that investor psychology. Here, though, movement happens generally a lot faster. So you can see things go up and go down at a much, much faster rate. Now, if we compare that for comparison, sort of in terms of a real return versus then a normal return. A normal return, again, how much has your money grown before inflation? Interest that you get in the bank, that'll be the growth of your portfolio with the bank before inflation. Real return is how much has your money grown after inflation. So very simply put, real return versus actual return is what is it worth now and what can you buy for it now? And this is where you will often find people who have investment portfolios, or very simply put, people who have property investments, property portfolios. They will see that my property has grown by X%, and then the following year it grew by X%, and the following year it grew by X%, and the following year it grew by X%. So it's been growing and growing and growing and growing and growing. And let's say I started off with to make life very simple, I started off with £1 million property, and now it's worth, let's say we're 5 years later, and it's worth 1.5 million, completely arbitrary numbers. And I look at that and I say, wow, I've grown quite well over the last 5 years. But then I go and I sell that property because I want to be able to use that money for something. So I sell it, I get my 1.5 million. And now what I wanted to buy with that money, I can't buy anymore because everything else has gone up at a much, much faster rate. So in a real return, although my property may have been growing at, say, 10% or 8% a year, in actual fact, really, it's been growing at a much, much lower rate because it's been going slower than the rate at which everything else has been going up in terms of price. And that's something that's very important when you're building an investment portfolio, when you're building investments, buying investments, where the aim is to be able to use that money later on in life. Local versus offshore, what does that mean? And you'll often hear people say, local, I have this, but I have an investment in South Africa that invests offshore. I have an offshore investment that's this. And then you look at it, in actual fact, it's really a local investment. So what is the difference? Now, domicile. What is domicile? Domicile, very simply, is where is that investment held? Where is it actually situated? So if it's in South Africa, then it is, from a South African perspective, local. If you're living in Hong Kong, for example, and you're a Hong Kong national and Hong Kong resident, South Africa would be offshore compared to Hong Kong. So again, from a South African perspective, what is local? Anything that is domiciled inside South Africa. Offshore is something that is domiciled abroad, outside of South Africa, meaning it is not held in a South African in the South African jurisdiction, in the South African country. It is held, physically held, outside of South Africa. Now, a local investment or a locally domiciled investment in South Africa, for example, can invest in South Africa. And it can invest in things outside of South Africa, even though it's held inside South Africa. What could be a combination? An offshore investment that's domiciled abroad can invest abroad. It can even invest in things that are inside South Africa. So, you can see where things start to become a little confusing now. But where it becomes very important is that regulatory environment. What laws, courts, what jurisdiction is that investment held under? Now, if it's local, if it's domiciled in South Africa, it will be subject to South African jurisdiction. It'll be subject to regulations within South Africa, such as your FACE, your CISCA, Regulation 28, Section 65. It'll be governed and controlled by South African law. Whereas if your investment is held abroad, it'll be governed by the laws within that particular country, not within South Africa. And this can become very important when we look at things such as investment restrictions with regards to Section 65 or Regulation 28. Whereas you very often won't have those sort of restrictions abroad. And then again, currency is the other side of it. In South Africa, as a local investment or locally domiciled investment, you can still invest in dollars, euros, pounds, rands. Very often there'll be all sorts of limits or minimums and sort of regulatory rules with regards to that. When we look at offshore, though, an investment, for example, abroad, can often invest directly into those foreign currencies, without any regulations or any restrictions. So this is why we say local versus offshore, because you can have a local investment and it can invest abroad, but it's still a local domiciled South African investment. You can have some who think they have offshore, but it's still actually in South Africa, just underlying investing into countries outside South Africa. And then you can have an offshore investment, one that is not inside South Africa. It's not subject to South African geopolitical events. It's not subject to South African regulation or restrictions of the regulatory environment. It's not subject to South African currency, exchange controls or taxes. It's completely outside of South Africa. The next thing, so once you've decided, are you going to go local or offshore? Next thing that you'll hear often is active versus passive, or managed is the other word that many people will use, managed versus passive investments. Now, what are the differences? If we look at how we compare these two, active, meaning managed, you physically have someone that is, or a group of people physically managing that fund or that portfolio, monitoring its performance, making tactical changes along the way, adhering to a mandate. Whereas when we look at your passive, very often these are unmanaged and they follow a benchmark or they follow an index. And when that index goes up, the fund goes up. When that index comes down, the fund goes down. There is no one in place or no management team in place to say, right, as things are coming down, we need to make adjustments that we don't drop all the way down and try and mitigate that downward trend. You just have to follow it all the way through. It is a tracker, as some investment companies call them. It's passive. It just follows whatever that index does. Now, what are the costs involved? Well, obviously, if you're going to have a team of experts or managers managing it, it's going to be more expensive because someone has to pay those sort of salaries. And again, at the end of the day, you get what you pay for. Whereas your passive funds are a lot cheaper. Again, why? When markets go up, they'll go up. But when markets go down, they will go down along with the index. There is no one in place to try and help mitigate that downward trend. What is the advantage then? Well, very simple. That advantage is that a manager can make adjustments in bear markets to limit losses, or they can even try to outperform when markets are going up. So what percentage of passive managers underperform their benchmarks? It's a very interesting question that, I like. It's one of those sort of nice questions. Think about it very clearly. What percentage of passive managers, if you're in a passive fund, how many of those passive funds actually underperform their benchmarks? And for those of you who don't know, the answer is 100%. All passive funds underperform against their benchmarks. Why? Because passive managers cannot outperform their benchmark because they simply invest in that index, in that benchmark. And obviously they need to charge a fee. As small as it is, it's a lot cheaper than many of your other funds. They do still have to charge a fee for doing so. And as a result, it means that that net growth that you're getting is less than that actual benchmark. So for example, if you have a passive fund tracking the S&P 500, would you be able to outperform the S&P 500 or even keep up with the S&P 500 in terms of its performance, that benchmark? No, because you're going to get that S&P 500 less the fee that's being charged. So that's something that you may want to consider or remember when going through. You get what you pay for, essentially. Then comes your risk profile. Now, I like to refer to that as your seesaw. So you've made yourself you know where you want to go, you know how long it's going to get you there, you know what's needed to get you to that particular point of view, you know whether you want to do it locally or offshore. You also know whether you want to be able to outperform or whether you're just happy going along with whatever happens in the market, and when things go down, you just go down with everyone else. So now, how do you choose which of those things to go for in terms of your risk profile? Are you that slow and safe? Are you that fast and risky, or are you somewhere in between? And again, this needs to match your investment timeline. It needs to match that journey. If you want to make, let's say, again, completely arbitrary number, you want to make $1 million in 5 years, and you're determined you're going to save what's needed. You're not going to get there by investing in property, which is a 10 to 15, 20-year investment term. You're going to want something that's going to grow a lot faster and in a much, more efficient way. So let's look at that, that risk profile, that seesaw that I like to call it. Now, you get the slow and safe where the risks are low, but the rewards are low. And again, so it's better suited for that short term. Why? It's not dependent on market conditions. Let's say you wanted to save money to go on a world tour and it's 2019, you put all your money into that, investment or savings. A year later, COVID hits, markets are down. What do? If you were in that slow and safe, it doesn't really matter because your money was in the bank. It's not going to suddenly drop 20 to 30% like markets did. It's just going to be going along slowly and nicely with those interest rates. The other side of it is you get your fast and risky, where the risks are much higher. Yes, because the market drops, your money drops along with it. But something that is very important to be able to comprehend and to be able to understand is that you get two different types of values. You get your indicative value or paper value and the actual real value. And I always refer to it as slices of cake. If you buy a slice of cake for $10 and tomorrow, cake sales drops out of the floor and people will only give you $5 for that slice of cake, what do you have? You don't have $5, you still have that slice of cake. However, if you sell that cake, then you've lost money. And it's the same with that fast and risky. When it comes to investments, the only time you actually sell is if you actually sell out of that investment. The idea is to buy when it's lower. That way, when it goes back up again, you can make a lot more money. You buy when it's low, you sell when it's high. So yes, the risks are higher, but the rewards are also much higher. And that is also why that timeline, that typical timeline that you should be looking for when you're looking for that fast and risky, is more that medium to longer term, where if a pandemic comes along, if a war comes along, if a depression comes along or recession that you don't need access to that money right now, you can afford to wait until that money grows and gains back its value again. And again, access very much dependent on market conditions. Markets go up, they go down, they go up, they go down. And you need to be able to not need immediate access to that money when markets are going down. Ideally, you want to be able to be adding money when markets are going down. So what are some of the products? If we've looked at the risks and some of the jargon and lingo, what is out there? And this is often where getting professional advice can save you a lot of money in the longer term. You get retirement annuities, otherwise known as RAs. You get unit trusts or collective investments. You get trading accounts, direct equities. You can get money market instruments. You can get linked in LISPs, as they call them, or linked investment savings plans, stokvels, direct property, your residential, even commercial options. You get your REITs, your real estate investment trusts, government bonds, corporate bonds, endowments, tax-free savings accounts, call deposits or fixed deposits. So how do you know which one you should actually use? Again, that'll determine on understanding what is the goal, what is the destination, and then making sure that the product you choose suits that particular goal. Then we look at all the underlying things, the risk profiles and everything else within that particular product. Now, there are a lot of options out there. So how do you determine which one? If we look at, and I actually call this so many options, there are 20 banks in South Africa offering, and I looked at the major banks, there are 20 banks offering over 123 different products. So for you that wants to be able to save, and you don't even know what you want to save for, or invest, you don't even know what you want to invest for, how do you know which one of these 123 different options are the right one, is the right one for you? And even if you do know what that destination is, again, how do you know which is the best one in terms of that more than 123 options that are available for you? Nedbank, if you go into their website, when you look under savings and investments, they have 17 different options that you can choose from. ABSA has 31, FNB 30, Standard Bank has 14 different options, Investec 17. Things become a little simpler with your newer and smaller banks, Capitec, African Bank, Discovery Bank. Again, they have 4 different options or 5 different options, but which one of those, and perhaps the other banks that have more options available, there's one that's better tuned towards your particular goal. Again, remember that route planning, finding the most efficient route for you and where you want to be able to go. So that was just the banks. Now, there are also other things that you could use. There are different investment companies. There are insurance companies, Sanlam Mutual. There are in different investment platforms, Capital International Group, Ardan, many different companies out there. And then, of course, there are the banks. So if we boil down to the most basic, simple, and this is now not taking everything into consideration, this is just narrowing it down to the real basics, just the who do I set up my investments with? Well, there are already 4 options. Which one of those options best suits your journey and where you want to be able to go? If we then look at the different products from all 4 of those different institutions, well, there are a lot of different products. There's those unit trusts or linked investments. There's endowment policies, retirement policies, tax-free savings accounts, fixed deposits, savings account, life bonds. So now we need to make another choice once we've chosen from the first 4. Then how are you going to actually own that particular investment? Or how are you going to set that up? Are you going to do it in your own personal name? Are you going to do it within a endowment style wrapper? Or are you going to do it within a trust, either locally or offshore? Or are you going to do it within a pension scheme, again, either locally or offshore? So suddenly that list of options becomes quite a bit more and becomes a little more complicated in trying to narrow down which one is right for you. And then once you've chosen the who, what product and how you're going to own it, what are you actually going to be investing in? Is it going to be private shares or listed shares, government bonds, corporate bonds? You're going to have some cryptocurrency in there, perhaps. Is it just going to be cash, forex, CFDs, index funds or ETFs, those mutual funds or hedge funds, commodities, commercial property, residential property, or different types of alternatives, credit swaps? What are you going to be actually putting within that? And then the option becomes even more and more and more. And then add to that, you can have all those options either back home or abroad. So you can have it either locally or offshore. And now suddenly the list of options that you need to be able to choose from to navigate becomes considerably more. And this is where very often either educating yourself or getting the right advice becomes extremely important. So again, that's so many options. Simply looking at the bank, which products, locally or abroad, which of the underlying holdings you're going to use, if we cut down on all those different sort of options, if we look at it from a South African perspective, that previous rainbow, what would you call this, a pie chart with so many different colors, if we cut out what everyone else usually cuts out, they don't look at investment companies, they very often only look at insurance companies or banks. They won't often look at life bonds. They won't even consider it. Won't even know. They won't hold it within a pension. 99% of South Africans will do it in their personal name through an endowment or through a pension. 99% will do it with local companies, not international companies. And then most local, 99% of South Africans won't look at, when they're setting up with those companies, won't look at things such as direct commodities or direct commercial property and alternatives and corporate bonds and or cryptos. They will narrow that list down so much that at the end of the day, that blacked out portion, they don't even look at. You're missing out on the way I've thought. Did I put that in here? No, I didn't. I was going to say, it's like going to, someone once explained this to me that way, and it made good sense. It's like going to a buffet. Imagine one of those big international hotel buffets and only choosing from the breads. There's a lot more out there, but most people don't choose from anything else because they don't have either the knowledge, the experience, or the advice to be able to do so from others. So, as I said earlier, so many options and yet so limited. If we look at just the investment funds, so simplifying it down to just your standard, ordinary sort of investments with insurance companies or investment platforms, how many different open-ended funds are there that you can invest in? So let's forget about direct equities. Let's forget about direct bonds. Let's forget about property and all these other things. Straightforward investment funds. Now in South Africa, there are 1,878 investment funds. 860 are offshore, and there are also 221 South African-based hedge funds. Now, if we compare that into the UK, someone living in the UK, for example, has 4,500 based UK investment funds and 8,758 funds available to them overseas versus what we have in South Africa, only 860. And if we compare that then to the US, in the US, they have 12,782 US SEC approved mutual funds and ETFs versus, again, our only 1,800. So if we look at that slice of pie, the blue is what's available to everyone else. The green is what is available to you as your local investment. And that local investment means local domiciled, whether you're investing locally or whether you're investing offshore, just because it is domiciled. It's set up with a South African company inside South Africa. So, I did add the image. So like I said, it's like going to a buffet, a huge international buffet, saying, no, thank you, I'll stick to the bread. So how do we narrow down those options? How do we navigate them? You need to know why you want to save or invest. Why do you want to build wealth? Again, what is that destination? Wealth as a journey. Where are you going? Where do you want to end up? By when? And then figuring out what the best route is to be able to get you there. Based on where you are and where you want to go, choose the most appropriate solution based on tax, because that will play a very big role, based on currency, based on your gut feel, and based on your knowledge and experience. And if you don't have the knowledge and experience, then get that knowledge and experience from someone else. Seek financial advice. Seek advice from someone who understands and knows all of those options, not just the local options. Get someone who knows everything. I like to, in very many of my meetings, refer to clients when I'm talking about 3 deadly shins, the 3 things that erode money. While you're trying so hard to make your money grow, to build that on that foundation, to grow that wealth, there are 3 things trying equally hard to actually erode, to weather away that building that you're trying to build. And it's tax, currency, and inflation. So those are very, very important things that one needs to consider looking for where and how. Tax. Now, we all know South Africa is a high tax jurisdiction. Anything that's income in nature is taxed up to 45%. Anything that you invest in or saving that's dividend in or equity in nature, you get 20% dividends withholding tax. And anything that's capital gains tax in nature will be taxed at up to 18%. Now, if we compare that to other countries around the globe, or jurisdictions such as the Isle of Man, or Guernsey, or the Bahamas, and there are so many of them where it's 0% tax. So again, those three deadly shins, any financial advisor out there, any website, any calculator will agree and will tell you that tax-free savings is way better than a tax savings. Very simply because you don't have that drag. You don't have to, with every time that your money grows, the taxman takes a portion of it. Now, the only way you can do that in South Africa is in a retirement fund or pension staff plan or a tax-free savings account. The problem, though, is that with retirement funds, it must be taxed as income. And look at the above there. Income is the most expensive type of tax. Tax-free savings is great as well, but you can only pay tax. You can only save 3,000 Rand a month, or you'll end up paying a tax penalty. And again, it doesn't matter who you go to, whether you're going to 10X, whether you're going to Discovery, whether you're going to Sanlam, Old Mutual, ABSA, Allan Gray, any of these companies will tell you that tax-free savings is way better than regular savings. But, and this is where it's important, look at Allan Gray's warning, same as ABSA's one before that. Is it suitable for you though? Because if you are not saving 3,000 Rand or less, you could end up paying 40% tax on any growth above that. So be aware, get advice in terms of navigating it. Again, currency, those three additions. Now, there's something that's very common referred to as the 10-year slide. Whether you're doing it in euros, dollars, or pounds, the Rand on average loses 5% of its value each year. That's on average over the longer term. Now, very simply, to simplify this in its most simple element, if I gave you any kind of investment or any kind of savings and told you you're going to lose 5% every year for the next however many years, would you do that? Resoundingly, most people will say no, yet most people will go and take money, send it back to South Africa, and then invest it in rands, where they lose 5% of their value over the longer term. So same as if you were something like it when it comes to people who like property. I want to buy a property, and I'm very much for property in the right type of portfolio. But again, if you're going to earn rent one day, if the aim is to get rent, would you rather get your rent in rands, or would you prefer to get your rent in pounds and dollars? I've never had anyone say, nah, take the rands instead. So that is what we refer to as currency depreciation. And if we look at that, and this is why I say over the longer term, because if we look at it, doesn't matter how many years we go back, you can see that the rand, we call it the two-step currency because it goes one step forward, two steps back. There are times when it does well, but it always comes back to that norm. It always tends to be that that depreciating negative of currency over the longer term. So very simply, if we look at it here, and we're looking at the dollar versus the rand in 1980, every $1 would get you 1 rand. So if you had $100, you'd get 100 rand. However, by 2000, that $1 would get you 7 rand. Now, that $1 will get you 18 rand. So imagine you had your $100 and you kept it in dollars rather than sending it back to rands. Instead of getting $100 like to 100 rand like it was in 1980, that $100 now would be 1,800 rand versus only getting you that smaller amount. And then something that one mustn't lose track of is, tax. Maybe you don't mind paying tax. You like what tax does. Also, maybe you don't mind keeping it in rands because you feel the rand is going to one day become the next global stable currency and overtake the dollar, the pound, and the euro. But there again, ask yourself in terms of your gut. What is your gut feel? Because that'll help you also determine where, local or offshore, hedge your gut. What are your personal views in South Africa? On a scale of 1 to 100, put down the pros and cons. Do you see us going downhill, Zimbabwe style, where the currency continues to weaken, where it's still politically unstable? We still have land expropriation, a bill which was recently passed, where we still end up with corruption, inflation, unemployment, crime, and violence, unstable power supply. Or do you genuinely think we will possibly go that Singapore route, where we will end up with a stable, strong currency, politically stable with no corruption, low inflation, low unemployment, brilliant power supply, a safe living environment? Where do you see? Do you see us going down, or do you see us going up? And if you see us going down, then it just simply means that more of your money should be abroad. And if you see us going up, then it means that less of your money should be abroad and more of it should be locally. So then this brings us to the knowledge and experience side of it. So, understanding some of the basics, some of the terminology, what, do you, with all those options available, with all those products and choices available, with taxation and currency all adding to those options, do you get advice or do you do it yourself? Now, given the diverse product range, the sheer number of choices and options, the different asset classes and investment types, the risks involved from the different market institutional risks, currency to geopolitical, liquidation or liquidity and concentration risks, do you feel you have the knowledge and experience, as well as, and this is the most important thing, as well as the time to be able to do it yourself? If not, speak to someone. Now, when you are speaking to someone, what can you typically expect? Now, if we look at the EU, to be able to be a financial advisor or to give advice you need a degree in finance. So, you can't be a car salesman one day and the next day you're telling people how to invest their lifelong savings. In the UK, you need a level 4 qualification in finance. In Australia as well, you need a degree in finance. In South Africa, surprisingly enough, you need a matric or a matric equivalent. And it doesn't have to include finance. So for example, you could have someone with a standard 8 or grade 10 qualification and a 1.5 year admin course at Intech, and that would qualify you to be able to give advice in terms of South Africa. That's essentially the same as a UK level 2 qualification. So if you're going to get advice, if you're not going to do it yourself and you are going to get advice, make sure you're getting advice from someone who actually knows what they're doing, who's qualified, and also qualified from an international perspective, not, an ex-teacher or Tupperware salesman. Now, let's go back. If we look at the most common one where people do it themselves, I come across a lot where you get people who like to what we call day trading. Now, what is the difference between day trading and investing? What is more profitable? Is it day trading or investment? What are the similarities and what are the differences? Just to help those when it comes to trading. What is it? What is it everyone's always going on about? Now, investing is buying something, an asset, usually something like an individual stock, a mutual fund, or an ETF, a tracker, as I said earlier, in the hopes that your money will increase over time, that it'll grow and become worth more. And because most people invest for medium to longer term goals, like buying a house, paying for college, saving for retirement, often they will tend to hold these assets for a longer time, meaning years, if not decades. When it comes to trading, though, this is very different. Here, trading is buying or selling of financial assets. Again, very often individual stocks, ETFs, which is a basket of other stocks or assets, different bonds, commodities, and more, in the hopes of making a short-term profit. So the aim is not to try and make a long-term profit and to grow your wealth. The aim is to try and make money quickly over a shorter term. And traders could be buying and selling investments multiple times a day, a week, or a month. So it's generally not for years or even decades. So what are the similarities between the two of them? At their most basic level, they are, trading and investing are identical. Both involve opening an account to buy and sell investments, to buy something, make it worth more, and then eventually sell it. And each offers you the chance to be able to pick from a wide range of different types of investments to reach your personal goals, and both involve risk. While long-term investing benefits from compounding growth and economic growth over time, day trading relies on exploiting market inefficiencies over a very short term, that price volatility, buying within a day or within a few weeks as prices move. Investing may allow you to gradually build your wealth and potentially earn dividends without the need to constantly, every day, be looking at what your portfolio is doing. Is it up? Is it down? Do I need to buy? Do I need to sell? It's that more slower, more medium term. However, day trading may be an option for you if you have a high risk tolerance and you have the ability to dedicate a substantial amount of time to monitoring the market. Because day trading, if you're going to take advantage of the highs and lows and the selling within the days and weeks, you need to be able to know exactly what's happening all the time. If we look at the opportunity for compounding returns, now compounding is obviously when you earn returns on your investments, and those returns then also earn returns. So it's growth upon growth, and then eventually growth upon growth upon growth upon growth, and it can become quite a substantial amount as you go, that continued growth. Also why tax-free savings do so much better than regular tax savings, because the compounding growth is much higher when you don't have tax taken away from that money. So when you put money in the stock market, you create that potential for an investment's value to compound, to get bigger and bigger as time goes. But compounding doesn't always work in your favor, especially when you've got shorter timelines, because when stock prices go down, it means then that also, just as your profits get bigger, in terms of compounding when things are going up, losses get bigger when things are going down in terms of compounding. So while the pluses and the minuses of compounding, impact both investors and traders, trading may come with greater risks because of the shorter timeline to be able to recoup losses. So investing for the longer term gives your money that chance to recover and grow again following a downturn, whereas that's not always the case when it comes to trading. Some more differences between trading and investing. Timeline isn't the only difference, that longer term, medium long term versus that short term. The risk of loss, the shorter your timeline again, the more concentrated you are in just a handful of holdings, the riskier it becomes, because you haven't spread out your risk over a larger area. It's all within a very small area. If you're buying individual stocks, as most traders do, that raises the risk because you could lose the money you invest. Diversified funds, meanwhile, spread your risk across many hundreds of companies, different sectors, different geographical regions. You're not all within one particular region and then within one particular company. To turn quicker profits, traders often may purchase more complicated types of structures or assets, such as options, futures, and swaps, and may even make use of margins. And although these techniques hypothetically may provide you with a higher potential profits, they also carry higher risk that can result in a much greater loss. So that seesaw, you've gone from being slow and safe to fast risky to being extra fast, but also extra risky. Tax implications, something that's very important to be aware of, is that although you may earn profits, anytime you earn a profit, the taxman wants his cut. And income from day trading is often seen as income tax rather than capital, as it is with investment funds. And remember that income tax is up to 45%, whereas capital is only up to 18%. And then, something that many people don't look at is that time and effort, because the amount of research it takes, successful trading can be and often is a full-time job. So you need that time to be able to monitor those markets, be in the know, to be able to do your background research, not only on what's happening from a macro economic position within the area that you are investing, but also the political impacts, as well as then the inner management and governance of the actual company within which you're investing. So long-term investing, meanwhile, most often it takes that set it and forget it mentality. You need to be able to do your reviews, make sure that things are following that sort of, the projected outcome. As I said, in terms of that journey, monitor it, make tactical adjustments, but you don't need to be there every single day, watching an eye out on it every single minute in case something suddenly falls and you want to be able to get out quickly and then buy in somewhere else. Whereas investment, you don't need to do that. Also, why you need to know that you have someone else who is able to manage that for you. And then finally, portfolio representation. Due to the amount of risks involved, trading typically only represents a percentage of someone's total investments. And I tell a lot of my clients, particularly those who have different types of equity portfolios on their own, I like that. I do enjoy it when clients do have that. It very simply makes my job a lot easier because they understand the risks, because very often they will end up losing their money in terms of what they have within their own equity portfolios. Whereas because I take that investment sort of route, it's a lot more subdued. So it allows them to take riskier bets in terms of, if you have a proper investment portfolio set up, it allows you to take those little bets on your own and have your own little portfolio, and it allows you to learn about markets. Can you actually make money? This is something that gets asked quite a lot. Now, you can do your own research on this, and you can do your own Google search, ChatGPT, whatever it is that you want to be able to do. Very simply, if you were to read through everything and just sum it down, the success rate is extremely low. The fact that only 13% of day traders maintain some kind of profitability over 6 months, and only 1% manage to succeed over 5 years. So you'll get those who make a bit of money now, but 6 months down the line, they've lost it all. And most, 99% after 5 years, have not succeeded. Financial losses, 72% of day traders end the year with losses. So, and that persistence against losses. Most day traders typically will face a financial loss for 6 months or more before they finally give up. That high risk of total loss, a common saying suggests that 90% of day traders lose 90% of their funds within 90 days. And that's because, again, you can make money, but it's a full-time job. You cannot be doing your normal job and be doing day trading. You need to be able to be awake in the market where you are investing. You can't be in Asia but investing in stocks in the US and be sleeping while most of that's happening. A report by the financial industry regulator in the US in 2020 conveyed that a whopping 72%, again, of day traders end the year in financial deficit. So they end up with losing their money. Another study in Shog, monitored by 20,000 day traders over a period of 300 days, and 90% and 97% of these day traders all lost their money. So you can make money, but you need to be that 1%. Something else that people often look for, which I thought I would cover very quickly, is stokvels, because it's also becoming a newer and more prevalent sort of way that people want to be able to save. And there are over 800,000 stokvels in South Africa with a value of over 45 billion. And while considered generally safe, why? They're generally considered safe because usually, in the traditional sense of a stokvel, you know your other stokvel members. And there is no requirement to recruit members like pyramid schemes. That said, though, with the onslaught of technology and AI, the number of stokvels that have grown where people don't know who the other people are within the stokvel. There have been some very large stokvels that have gone bust, like the United African stokvel, where members lost between 200 and 500,000 rand. So stokvels, are a good way of saving in a group or in a community, but do be aware that there are risks. So what are those risks? And in the next webinar, I'll go into risks in a lot more detail, how to be able to calculate your risk profile and which investments suit you. We'll also look at AI and a lot of other things. Very simply, these are the risks that you have with investments. There's currency risk, inflation risk, equity risk, interest rate risks, commodity risks, idiosyncratic risks, systematic risks or systemic risks. There's capital risk, institutional, liquidity, longevity, credit, horizon risk, management risk, concentration risk, which I mentioned earlier, regulatory risks, geopolitical risks. As you can see, there are a lot of risks available. So it's not just managing and being able to navigate which product suits you and then which underlying type of investment suits you, but also being able to navigate the different risks that are available out there. And different types of investments will have different risks. Even savings will have risks associated with them. I'm going to go through some of the most basic, simple ones. Currency. Again, the fact that the currency can either gain value or lose value based on market conditions. How do you reduce that risk? You don't put your eggs in one basket. Very simply, you invest in more than one currency. So if the rand, for example, does suddenly lose value, not everything you have has lost value. Some of it is in other currencies which have gained value. Inflation. Inflation is the risk where things become more expensive at a faster rate than what your money is growing, meaning what you have will be worth less in the future and will buy less than it's actually able to buy now. How do you mitigate or reduce that type of risk? Well, very simply, if possible, you invest in jurisdictions with lower inflation. Equity risk, also known as investment risk or stock risk, that's the risk associated with the company's shares and the share price actually declining, leading to a loss in the equity value. And this becomes a lot more risky or prevalent with your day trading. So how do you reduce that? You diversify. You don't put all your eggs into one basket. Interest rates risks, the fact that investments and assets, especially fixed income ones like bonds, will lose value because of the changes in interest rates. So how do you reduce that sort of risk or mitigate that sort of risk? Again, don't put everything then into something that is interest-based. Diversify into different types of asset classes. Commodity risks refers to the uncertainty of the future market value and the size of a future income caused by that fluctuation in the prices of commodities, such as grains or metals. And same as with interest rate risks. The easiest way to mitigate that kind of risk is to diversify into different asset classes. Institutional risk, that's the risk that the company with which you've actually got your investment goes bust, and that they're bankrupt or unable to fulfill their obligations. How do you reduce that kind of risk? Because let's say I put my investments or my savings with company A and company A goes bust, which you might think won't happen. But over the last 30 years, 18 different banks have gone bust in South Africa. Very simply, invest in a jurisdiction where you have some form of government-backed investor protection, or there is some kind of reinsurance scheme, so that if by any chance, whether it be because of a financial crisis, whether it be because of a war, whether it be for whatever reason, if the company with which you've got your money goes bust, at least you know there's some kind of insurance in place. Capital risk, that's the risk that you may actually lose the capital that you've invested, your own money that you've put in. And again, the easiest way to reduce that or mitigate that is to diversify your investments or look for solutions where you do have some form of capital guarantee. Systemic risk, that's the possibility that an event at a company level can trigger a severe instability or collapse of that entire industry or even within that economy. You know, that global financial crisis from 2008, so Freddie Mae, that too big to fail. Now, how do we mitigate against that? It's almost impossible because it's unpredictable and like I say, impossibly to be able to avoid. So diversify not only within an asset class or within a sector, but also from a geographical point of view to help reduce that. Systemic risks or systematic risks this time. Systematic risk is that undiversifiable risk, something that will affect the entire overall market, not just a particular stock or a particular industry. And systematic risks are unavoidable and unfortunately uncontrollable. It's very difficult to be able to try and mitigate or reduce that. Idiosyncratic risks, those are the uncertainties, that potential problems that are unique to that particular type of business or asset class or stock, or a group of stocks, for example, in a particular sector. And in some cases, it can be a very specific type of asset class. And again, the best way to reduce or mitigate that idiosyncratic risk is to be able to diversify into different types of asset classes and groups. Liquidity risk, that's the fact that you might not be able to have access to the money you need when you need money, either because it's fixed or because it's restricted. And there to diversify. Don't put everything into one particular type of investment. Choose investments that have different timelines and horizons, that have different liquidities. Longevity. Longevity risk is that you will actually run out of your money earlier than you expected. So, and this is where that journey, make sure your solution matches your goals, it's realistic in expectation, and it meets where you want to be when you want to be there. Credit risk, that's the ability for the company to repay the capital or the interest to you. And again, diversify and monitor company credit ratings. Horizon risk, similar to longevity risk. Here, when your time horizon and your investment strategy don't match. Simply, the type of investment solution you have doesn't match what you wanted to be able to achieve when you wanted to be able to achieve it. So ensure your solution and goals are aligned with each other. Geopolitical risk, that's that a change in politics or geopolitics can affect a change in the government, leading to market changes. And very simply, how do you mitigate or reduce that? You diversify across different geographic regions, different geopolitical regions, or choose geopolitical regions that are more stable and secure. Regulatory risks is something that I've seen with some clients. A change in regulation can negatively affect your investments. I have some clients, for example, who were very heavily into mining in a particular African country. Overnight, the law changed and they went from being billionaires to having nothing. So don't put all your eggs into one basket, and diversify across different jurisdictions. Market risk, the most easiest of them all, the loss of, in terms of investments caused by market prices moving. Again, diversify. Management risk as well, that all your eggs in one basket, you don't do that, diversify. So many options, so many risks, and so many opinions. Now, something that I like to say, and this is getting to the end now, but an opinion is a personal view or a judgment. And often it's not necessarily based on fact, knowledge, or personal experience. While advice involves guidance from someone who has that knowledge and experience. Expert advice involves guidance and recommendation by someone who not only possesses that knowledge and experiences, but is also often sought after, and has that expertise in various contexts, such as health, finance, personal development. It's based on that thorough study and experience, not just an opinion. So if we look at that in terms of the medical industry, your paramedics, nurses, theatres, all of them, for example, are medical professionals. But how many of them would you trust to do a heart transplant? Same as when it comes to the finance industry. There's your bookkeepers to accountants, your auditors, financial advisors, tax consultants. But yet so many people that I speak to would say, well, my mom said this, my dad said that, or my friend, with an easy equities account, or my work friend, or my cousin, or my sister said that. And very often they're not in any of the financial industries. So expert advice versus opinion. Opinions are like cell phones. Everyone has one. Expert advice is advice given by someone who has studied a subject thoroughly, who is very skilled at a particular job. An expert is a person with extensive knowledge or the ability based on research, experience, and occupation in a particular area or field of study. So as a South African living abroad and earning an income in a lower tax jurisdiction, in a foreign currency, with different options available to you, make sure you're getting expert advice from someone who is internationally qualified, someone with recognized qualifications in finance, tax, and investment, not that, what did I say earlier, that grade 10, standard 8 with an 18-month course in HR or something else. Someone with an international perspective and understanding, not SA-centric for South African residents. Someone who is well experienced, first-hand experience of life and financial challenges as an expat, understands firsthand the implications of banking and taxes and the options available abroad. Someone who is highly skilled with a long track record and solid reviews, able to navigate those nuances. Someone who quite simply is a specialist in their field. Someone who knows what they do. Advises South Africans abroad, does webinars, educates others, is not a generalist. Someone who does, generous, I mean, like the typical person who does investments, but also funeral cover, life cover, disability, or household insurance, car insurance, but you're going to rely on him to give you advice on living abroad in terms of expat finance. Go to a professional. Very quickly, independent versus tied. If you're getting advice, tied is giving you what I have. Independent is giving you what you actually need or want, building that solution for that journey. So the way I like to say it is, so you'd like a car to go camping that can go off-road with all the camping gear. So we go to the local car shop, and so I go down to Mazda, and what do? Well, this is the options that Mazda is available. Now, I can guarantee you, if I went to Mazda and asked them that I needed a car that can go off-road because I want to go camping, they're going to sell me one of these 6 cars. They're not going to tell me to go over to Land Rover or Hyundai or not, who's the Toyota or someone else. An independent financial advisor and a tied advisor may look alike, but under the skin they're very different, chalk and cheese. An independent financial advisor has no ties to any financial providers that can influence their decision on what they recommend or what services they want to be able to provide to you or can provide to you. Independent means having the choice of any financial products that suit the need of the client without restriction. Whereas a tied advisor is just that, simply what the description implies. They're employed by a specific company and can only give advice on that company's products, nothing else. Does it matter, the difference? Well, yes, because very often training standards will differ between the two. Financial advisors should hold professional qualifications and work within a regulatory framework. But an IFA is more likely to have a broader financial knowledge of a wider market because he has access to so much more than just a tied financial advisor. So what does this mean for you as a client? Well, unsurprisingly, obviously, a client approaching a financial advisor expects the best advice to suit their personal circumstances. A tied advisor should declare, and this is the thing, your tied guy with whichever company you're with should tell you, look, I'm only limited to giving you advice on the products that my company provides, but they're not going to do that, and they should do that at the outset. They're unlikely to say, look, this company actually has a better product. Whereas an independent advisor should offer unfettered advice, because why? They can choose from more products and services offered by any of the providers. So if company A has a better solution, they're able to tell you the best result for you or the best option for you is this result or this product from that particular company. So if we compare those IFAs and tied advisors, going to your tied advisors is like going to someone who works for a bank and means only receiving advice on products offered by that bank, while asking or consulting an independent financial advisor is like visiting a comparison site that's able to draw down from the whole market, not just that one bank. And then finally, as promised, my 7 steps to building personal wealth. A, make sure you are earning the most you can earn. Upskill yourself. Don't be afraid to go and look for that better position. You can't save or invest without income. So make sure you've got a good income. Or try and get to that better income. Do what's needed to get you to that higher level. Set goals and develop a plan. Understand what you want to achieve and then what the costs are in terms of getting there. Then start saving. Simply making money won't help you build wealth if you end up spending it all. Record what you spend, and this is a very nice thing, an important thing to do. Record what you're spending, even the small amounts. You'll be surprised where your money actually goes. Then once you've done that, you're able to cut that unnecessary expenses. You're able to identify things where money is bleeding out on things that you didn't even realize you're spending that much on. And then set savings goals by identifying how much you can afford to save each month in some form of disciplined saving plan so that it forces you to do that. Once you've got your savings going, that's where you need to now start investing, grow that actual money. Try and build upon it. Then, once you started that, protect what you have. Safeguard your assets from unexpected events. Minimize the impact of taxes. So have a look at your portfolios and have a look at the solutions you have and make sure that they're growing in a tax efficient way. Why? Taxes that often overlooked drag on your wealth building efforts. And then manage your debt, build good credit. It's worthwhile to take on debt for various investments and different purchases if you're going to leverage to buy properties, for example. So maintain and build a good credit score. So those are my 7. Again, that final one, once you reach that point, if you're going to make money, use other people's money to do so. That's when you start to enter that real wealth sort of scenario. I hope that was helpful for everyone. I see I've gone on way longer than the hour. I know there are a lot of questions out there, but I don't want to keep anyone longer, and I also have a meeting starting soon. What I will do is I will arrange a full Q&A session webinar, and I'll send the invites to everyone in this group that's joined today, and we can then have a chat some other time and go through everyone's individual questions. Thank you so much for your time. I appreciate it, and I hope to hear from some of you sometime soon in the future. Thank you very much. Bye.